You have rent increases, houses affordability, your food prices, food shrinkage, and your monthly bills of gas and electricity. Let's jump right. So here we have the consumer sentiment has dropped to a near all-time low. So you guys are not really spending. I'm gonna guess budget cuts. But I'm not surprised. It's really hard to afford stuff out there right now. We have inflation pretty high, even though, in October they didn't want to release that data. They didn't really need that data to be like, oh, looks like it's 10 pounds, $10 a pound for beef. Sorry, English is very hard. But coming up, we have lower income rents have experienced a sharp drop in funds left over after paying for housing. So you jump out there, you go buy that house, you're like, yes, Gordo, I bought a house. And then your tires go flat on your car, and you're like, I can't pay for anything now. And I have to go for a walk. I have to spend the next 4 months spending all my paychecks on my tires because it's so expensive out there. And yeah, that's just how it is right now. Everything's really overinflated. And here's the fun part, it gets worse. So, we have coming up, household growth is slowing from recent peaks. What? You guys are not buying houses? I wonder, could it be let me take a guess. You don't have money. Did I win? I probably won. I should get a prize. But you can see in a 2025 started dropping down. So looks like we're gonna have more houses on the markets. Which in the next slide, we have the inventory of the housing market climbing up, which I would say cool. Nobody's buying, so that's why that's going up. And you can see if you look at around 2008 when inventory starts dropping back down, that's only when we had a market crash. So this could just be the beginning. This crash may not even happen next year. It could take a while. So you guys also have home prices are historically high relative to incomes. As you can see, last time we had this was, you guessed it, 2008. Which means, ooh, yeah, if you really look at that chart, it looks really ugly compared to 2008, which means most likely the crash is even worse. So, I would say get ready. We also have the median age of US homebuyers. So, you go out there, get that degree, get that job, and then you keep working until you're 40, according to this chart. So, once you're 40, you can then buy a house, your first house. And once you hit 62, it looks like you can buy up all the houses, according to this chart. Buy up everything, have a great time, all that real estate just for you, all the rental properties. It sounds great. I don't know about that age though, it's pretty high. We also have the US price of natural gas delivered to residential consumers. So, if you look at this chart, if you haven't guessed, we're on the far right and we are way up in the sky. So, all time high of prices, fun. Last time we had all time high of prices, it went down. So, maybe it comes down, maybe it goes higher. Can I call the top on this just from this chart? No, but there's other ways to do that. We also have the average retail price of electricity in the United States monthly. English. But you can see we are the top line, the residential. And you can see it just keeps going up. It actually doesn't take a break. It just keeps going up. After '08, it just went flat a little, and then it just started climbing up. After 2020, just exploded. And that's what we're facing now. So we have housing costs going up. You guys have old people buying everything. And then you go out there, get your degree in your job, you're full of debt, and you have to wait until you're 40 to buy your first home. So, yeah, good luck with mental stability with the parents till you're 40. Or you can rent. That's up to you. But those are also really high. But for the housing sector, I have some news for you. So here is your housing sector. This is the symbol HGX, the Felix housing sector. When this goes down, prices of homes follow. When this goes up, the houses of prices, the price of houses goes up. So here we have a pattern. It can break in either direction. You have that yellow line, that is your 200-day moving average. And since you're above it, it wants to keep going up. So, yay! It may go up. It has a lot of encouragement to the upside. So, here we have the price target. If you break down out of this pattern, you can expect to go below the 200-day moving average, and then it'll probably bounce, hit the 200-day moving average, and then get rejected, and then go down lower, and then you guys get affordable housing. Yay! Or if it breaks up, you get more expensive houses. So the 62-year-olds can go ahead and buy up more of everything because that means in your 40s it's going to go to 50s and then 55 and then well 60 guys are already there. So you can go ahead and see maybe we have people buying their first home at 60 years old. How exciting is that? Don't be that guy. But in regards to Bitcoin, because I know I haven't quoted in a while, we can go ahead and look at this chart. Move it back to the daily time frame. I did adjust my line. I noticed in the chart I was wrong where I put it. I am very sorry. I had it just for reference down here at the bottom of this spot, because I saw a whole bunch of support and resistance there, but actually it was a little higher up. My bad, missed it. But you can see Bitcoin is still down below the 200-day moving average. It did bounce on that line that I didn't mark out correctly last time, and here it is, and it bounced on it. Now, oh, would you look at that today? There. Oh, missed it by a pixel. It touched it again. So this means one of two things. Bitcoin can go ahead and bounce back up. You can expect Bitcoin to go ahead and touch 101,000 if it bounces. It's really hard to reach, but might be able to make it, especially since it's under the 200-day moving average. But if it breaks the blue line down below, you keep heading lower towards the price target that I set. And just for a refresh, the price target is 57,742. That is the price target I set, even though you may hear on the news that Bitcoin's going to like 200,000, 150,000, 300,000. I don't even know what goes on in the news. I just look at the chart. And you guys may be saying, But the market went up last week. Yes, yes, I forgot to record. My bad. But here you go. Got it all for you. I did notice after reviewing the videos, my line was a little sloppy. You guys are gonna probably call me out and be like, "Oh, you drew that wrong. You're not good at this." Hang on. You can go here. Right? Yeah, right there. Perfect. So it was just a few pixels off. Don't don't take it too bad on me. Also, I did say you guys probably wouldn't hit that price target that I set because you're above the 200-day moving average. But I did say you might get a retest, which it looks like that happened. I'm going to go ahead and delete this price target and actually draw you guys a new pattern that looks like it's forming. So go ahead and delete this. I did add a form of resistance on here. That is the blue line that it looks like it got rejected off of. But there is something else here that I want to point out. Go ahead and change the chart to the line. Go ahead and take my... Oh, this is going to be very stressful. Okay, I got this. We're going to go ahead and go here. Here's a shoulder. Okay. Here's a head. Okay. Ooh. Okay. Here's a right shoulder. Okay. Okay. Okay, we're good. So, here you guys go. We have a head and shoulders pattern that looks like it's forming. If you remember on the TLT and the bond market, I said if you break the bottom line right over here, you will go lower. Keep in mind, we are still above the 200-day moving average. But if we do break that bottom line, we go lower. If we don't break the line and we reverse and go above the right shoulder, then that means the head and shoulders pattern has been nullified, big word again, sorry, and not put into play anymore. So, also, we have a price target I forgot to mark out. Man, you guys need to call me out more. But you measure from the head to the support line and then move it over. Okay. And that will put us, if it breaks, down to the 200-day moving average. And we might, well, we'll probably bounce off of it because it will be overextended by that time. So you can expect things to go down after that. Also, one more thing, sorry to keep you on the phone, we have TLT. Now you guys might be saying, oh, it invalidated because it went over that right shoulder. Yeah, you're right, it did invalidate. So no more head and shoulders pattern anymore. But if you do look at the chart, this actually surprised me this morning. You're way down there, and you're above the 200-day moving average. Now, I get to give you guys a fun little lesson about gaps. So, when you leave a gap like this on something that has a whole lot of volume, it likes to go ahead and fill it. So, what can we say about this? Gordo, I don't know how to trade. Okay, I'm telling you right now, when you're above the 200-day moving average, you have a gap down. You already nullified, big word, the head and shoulders pattern. So head and shoulders pattern is not in play anymore. We're not bearish anymore on the bond market. Now, if anything, we are bullish on the English, sorry. We're bullish on the bond market because we gap down and now people want to fill that gap. So Same reason why investors buy dips. Think of it that way, if you understand that way better. But, anyways, we went over a whole bunch of things, and you guys might be saying, Bardo, what should I do? It just gets worse. Well, go ahead and start a business. Yes. And trade the stuff here. You guys are like, that's risky. That's gambling. No. If you know how to trade correctly, the percentages are in your favor. It's not like Vegas where it's in the house's favor. Here, it's in your favor. You just have to understand how the chart moves. And with that, I hope you guys go out there and start something so you guys aren't so broke and you can go ahead and do more consumer spending. And I'll see you guys in the next video.